Welcome back to another episode of ESOP Radio. I'm Ben Spade, and as always, I'm joined by Trevor Gilmore. We have a packed agenda. We're covering three things: the current state of ESOP legislation as of early June 2026, and what we're seeing with ESOP lenders and how lenders are getting more creative, and our outlook for the second half of the year. Trevor, good to have you here.
Always good to be here, Ben.
Well, let's start with legislation. A lot has happened since the start of the year. Where do you see things stand today?
Yeah, Ben, there's real momentum in Washington. So for those plugged into the space, you know what I'm talking about. For those new to ESOPs, you might not. The biggest story for ESOPs in 2026 has not been a new bill. It's been a fundamental shift in how the Department of Labor approaches enforcement. For years, the Department of Labor, aka the DOL, Employee Benefits Security Administration, also known as EBSA, that's what we call it in industry. So if you listen to an ESOP code head out there, they're going to say EBSA, had ESOPs on its national enforcement hit list. And basically what this means is, hey, let's inspect ESOPs, be out there scrutinizing transactions, what's going on, and so on, above and beyond just normal enforcement. So it's called what's called an enforcement priority. That created an adversarial environment. In January 2026, they removed ESOPs entirely from the national enforcement hit list. So that's huge. So basically, it's given a lot more comfort to both business owners and the entire ESOP advisor industry as a whole. So meaning ESOP advisors, quarterbacks, investment bankers, firms like Menke, the trustees, the evaluators, you name it, banks, the whole ecosystem there. So this has signaled a move towards a more principles-based oversight framework, meaning that there's going to be fewer surprise lawsuits and audits and a more predictable compliance environment. So overall, that gives ESOP companies much more breathing room, and we welcome this change with open arms.
That's a huge change. And as far as active legislation, there are several bills that are working through Congress. The Retire Through Ownership Act provides a clear definition of adequate consideration for valuing closely held stock. And when I say closely held stock, I mean ESOP stock, essentially. Stock that's not traded on, the New York Stock Exchange, NASDAQ. But we allow ESOP fiduciaries to rely on independent appraisals under the IRS ruling, Revenue Ruling 5960. The bill
and that's
passes,
been out there forever, right, Ben?
Oh, yeah. Well, that's what 59 means, 1959, so we have been dealing with this. It was this gray area where we don't know what adequate consideration is. And so the bill passed Senate in October of last year, and, we're hoping for it to pass the House and then hopefully get signed into law. But basically having a clear-cut set of rules as to how do we determine adequate consideration, how much to pay for these companies. The Employee Ownership Fairness Act is another one. That one was in the Senate, and it would remove these ESOP contributions from our total defined contribution plan limits. And basically, there's 415 and 404 testing are some of the two major compliance tests that this addresses. And one is the contributions that we make to ESOPs go against those limits. And so sometimes refunds need to be given if you contribute too much, either employer or employee, or we can have some excise taxes if there are too big of contributions. And so what we're saying is with ESOPs, they're not so much like 401ks that they need to be under that same umbrella. And so we're trying to remove those. And that's what this Employee Ownership Fairness Act does. And it allows these employees to benefit from both 401ks and ESOPs. And both these bills that I just talked about help remove a lot of friction from our system, our current system. And then the big one, Trevor, is and I have to look at the
Aurora, is it?
Yeah.
Which one is it? So Aurora is, and actually, let me talk a bit about the 415 limits. I mean, that's a huge thing, of course.
Yeah.
Fall under what's known as the defined contribution plans, just like 401ks. However, they're much different. We're talking about company stock, not necessarily cash just going in and getting allocated, and so on. So we're talking about stock that, gets allocated, right? So along with the spirit of that, treating it under the same bucket as a 401k, can definitely see the argument, hey, let's think about the ESOP limitations. And then I know, we're talking to clients all day long about the 450 and the 404, and so on, how it all works. I can definitely see that argument that, hey, let's think about this ESOP piece a bit different.
Right. Absolutely.
Yeah. So let's talk about Aura. Or Aura. They're talking about Aura rings here.
Yeah.
So Aurora remains one of the most significant ESOP builds in a generation, and it basically establishes a zero subsidy cost investment facility at the Commerce Department designed to unlock private capital for ESOP formation and recapitalization through federal loan guarantees. So basically, TLDR here, let's summarize what this means. It's very similar to the mortgage market is where people are thinking this should go. So you go out and get a house and traditionally you get a 30-year mortgage, right? Or maybe it's shorter, and there's all these different options, right? 10-year interest only, 15-year, 30-year AMR, and so on. Traditionally, the financing sources for ESOPs have been senior banks. And they'll, in a very simple example here, let's say a company is worth 6 times profit. The bank will probably come in and say, hey, we'll lend 2. So what about the other 4? Well, it's usually a seller note, maybe a private credit fund, although they're very picky on who they want to lend to. Today is June 5th. Wall Street Journal had a big article saying private equity is pulling back and so on. And, we see that, it's attractive for some industries, they're into, some not. But overall, there has been a financing gap for ESOP formations. Mm-hmm. And that has been a pretty large barrier, especially for business owners who want max cash at close.
Absolutely. And this was one of the major reasons why I was in Washington and talking with politicians last month, in early May, was talking about this and talking about how there's really, outside of the administrative costs, there's no cost to taxpayers here. It is basically the government saying, we believe in ESOPs. We believe they should be funded in a traditional sense. So we're putting the government backing behind these loans. So much like an FHA loan or an SBA loan, but a little bit easier to get because we're going through traditional lenders and saying, hey, I have this ESOP, I want to sell 100%, I want to sell 100 to the ESOP. And the lenders can say, okay, we'll lend, maybe not 100%, but 80%, 75%, however, wherever their tolerance is. And the government says that they basically sign off on it. And if the provisions aren't met, then, there's some safeguard there. And I think that's going to open up a lot of doors for these ESOPs.
And it looks like it's remaining active in committee right now. And that's huge because if it's not active, it's dead, right? So it remains active. Momentum here is building. So that's all positive sign. It seems like, hey, if you can figure out the financing piece, then an ESOP can truly come to the table and compete with other strategic buyers. Strategic, then you go in the whole value thing, but other buyers for the business that come to the table with most of the capital at close.
Right.
So this could be a game changer.
And you're right. If it's not active, it's dead. And kind of piggybacking on the funding side and also the activity is the progress we're seeing on the funding front in the fiscal year 2027 appropriations bill. So government, again, just talking about, okay, we're setting aside this money for something. The language that's included in there is directing the Commerce Department to address the financing gap with ESOPs. And so bringing in the previous legislation that I was talking about and that Trevor was talking about, they're trying to kind of move that needle forward and move it into the 21st century. And again, bridge that financing gap.
Exactly. Good point, Ben. And the committee report explicitly recognized that ESOPs can be an effective tool for retaining American companies, especially those undergoing business succession. And how many baby boomers, and now it's Gen X. We talk with a lot of Gen X business owners every day about, and actually now millennial too. Mm-hmm. Talking to a lot of millennial business owners who created their business 5-10 years ago, and they're wondering, hey, what is my plan here? Overall, we're seeing planning starting earlier versus in the past, and so many private businesses out there. All businesses basically have a succession problem, right? Every single one does. You need to have a succession strategy and so on. But the liquidity piece, that is what on top of a lot of business owners' minds, and it's not going to go away. So for ESOPs to come to be competitive, which a lot of people are aligned with the ESOP exit. We always say, if you own a business and it's better off independent, the ESOP is probably the way to go. If it's not, for whatever reason, key person risk, company isn't profitable, You need to be part of a much larger player to really, finish out the product stack and, be competitive and so on. Then, ESOP's not going to work, because the ESOPs are driven by cash flows. And by that, we mean you have positive, healthy, stable cash flows, increasing cash flows.
Mm-hmm.
Well, let's get back to the financing piece here. So overall, this is welcome news. And we definitely look forward to seeing what develops here, and ideally be a part of this move here. And in summary, it's a direct acknowledgement from Congress that financing remains an obstacle. So that's huge, right? Actually, trying to solve a problem, right? Which is very awesome.
Right. And, we talked a lot about the problem, but legislation is moving in the right direction there. And I think the real story is that Washington is finally acknowledging, with what you were talking about with EBSA, with what we're talking about lending, they're finally acknowledging what we and others have known for years, that ESOPs work and that they need better access to capital to help kind of grease the wheels of these plans and these ideas. And then speaking a little bit more towards lending, we've discussed the access piece, which is those government-backed loans, and that's being the biggest barrier. And we've been working on a couple deals together, and I thought it might be good to talk about how they're getting a little bit more creative. And I was always told that creative bankers and creative accountants end up in prison. So maybe that's not the right word, but what's kind of the cutting edge of what we're seeing in the lending?
Yeah, Ben. So what we're seeing overall is for quality companies out there, banks are opening up their pocketbooks and wanting to lend for ESOPs. So a lot of banks, in the past, you always had to go to the niche players, some of the big nationals, maybe a small few of the deals would go that way. And then you have regional players that are very into it and they have ESOP teams and so on, but it's always been kind of a niche market. And we're seeing that change a bit. We're seeing a broader interest in ESOP lending. And on top of that, we are seeing more creative financing. And we're not talking about the 7 mortgage crisis, or, stated income loans and, all that. So we're not talking about that. What we're talking about is, okay, we have a company in that earlier example that's worth 6 times profit. Well, the bank says, I'm comfortable. Company has a clean balance sheet. Cash flow is good. These ratios all look good. Coverage ratios, fixed charge, so on. But we want to manage our day one risk. So we're going to come in and lend 2 times that, but we're going to keep maybe another 1x on standby. And if the company performs and meets its covenants over the next several quarters, whether it's 3 quarters, 4 quarters, maybe up to 2 years, depending on what makes the most sense here, we're going to then release another 1x and then continue that path until the full ESOP is paid for. So what this means for sellers is that they get an upfront payment that they have and they can use and reinvest, if they're doing what's called the 1042 rollover that does take capital to do the tax deferral. If you're at 1202, and we're seeing more and more 1202 deals too, and you don't have to do 1042, you just have 1202 stock and don't pay capital gains on that piece. But now you have liquidity, from the sell. And that delta for the sellers, is basically a seller note, they're earning interest, but then it gets paid down, right? So we're seeing banks being much more creative and just saying, no, we're not just going to come in at 2. We're going to do this structure here where if the company performs, meets its covenants, and everything is going well, we're then going to basically draw down on that seller note and increase the total amount that we're committing. So that's great because that is much more flexible than the past, where in the past you would just see, 1 loan and that's it. Then you're talking about a holding loan, a holding facility 2 years in when you want to come in and refinance. So we're seeing that structure. These are called accordions. There's other terms in the banking industry to describe what we're talking about, but that's basically the gist of it, is looking at a long-term facility that is looking at the full value, the full cash flows, and basically timing the risk according to covenants. It is basically the drawdown on that. So that, can definitely be appealing. So a lot of clients are interested in that, because it's flexible, and so on.
Mm-hmm. And I think, that's very important, is that, whether it's an accordion, we're stretching out perhaps the time, or the elevator where we're offering more money if certain criteria are met. Neither of these need to open up a new loan. You don't have to do a new due diligence. You don't have to, the bank is now keeping their finger on the pulse for much longer, but in an effort to lend you more money and to maintain a stronger relationship. So, the company doesn't have to jump through all the same hoops of setting up a new lending arrangement for that second piece, that second tranche of funds. The bank says, we'll lend you this much now. And if it goes well, we could stretch that out, or we can, perhaps do some other elements. And I think that's important because it's beneficial to both sides there.
Exactly. And it really shows that lenders are looking for long-term relationships, especially the ESOP lenders, because they understand these are well cash flowing companies that are in it for the long game, and we see that in our client base, clients that we've been around for 52 years since 1974.
Yeah.
One of our advisors in the 80s did deals for $2 to $3 million, and now those companies are worth $200 million. So if you're a bank, involved in that whole process, that's been an awesome client. Think of the deposits, think of the treasury management, think of this and that. So banks are looking at the long-term relationship here and the long-term opportunity versus just, hey, this is what we see here and now, and that's it, and so on. So that's definitely a positive move for the industry is finding that, finding those long-term banking relationships that see the value. And then for the clients as well, having that long-term partner, because most successful ESOP companies do grow over time, and they're going to need much more sophisticated help over time as well. So that's been a total welcome change, and overall it shows the long-term thinking involved in our industry. ESOP is a long-term play.
Mm-hmm. And now you said a little bit about this before, but seller notes still remain common. And the classic financing structure is still a combination of a senior bank loan, like you said, 1 to 2 times profit, and then the remainders on that seller note. The seller takes that note for a period of time, and it gets paid over time. The structure's been there forever, but now we have more options. We could do a delayed draw note like you established, that accordion for future growth. That menu has expanded dramatically. And I think the other piece of that's cool and kind of important is banks are reaching out to us, and banks will say, hey, let me take a look at something. Even if they don't offer a financing for this particular case, they're curious about it. They want to see more. They want to see what are these companies doing, because you're right. They are great investments. They are strong companies that are around forever. But I think layering that menu has kind of expanded now, and the appetite has also expanded. And I think, coupled with that legislation, things are looking up.
Absolutely. And then also on the financing front too, we are seeing lower interest rates than we've seen in several years. So back when prime was 8.5 just a couple of years ago, senior loans were hovering around that. And now we're seeing loans somewhere like SOFR plus anywhere from 1.5 to 2.5, depending on company size, the cash flows and so on. So what that means for interest rates is, basically we're looking at high 4s to low 6s right now, right? So banks have become much more competitive with rates, but who knows where rates are going, right? Prime right now is where it's at, and who knows, but overall, the key summary is in this discussion is that, for companies with solid cash flows, you are most likely bankable, here on an ESOP trend. And it's talking about these acronyms here, or terms, the accordion, the elevator. SpaceX is going public next Friday? That's a week from today. Like, where's the rocket ship feature?
I know, to the moon element, right? That's funny. But a lot of what you're saying, is we're kind of talking, we're touching on that next topic, and it's a great segue. Is the outlook where lenders are happy to lend. You and I both we were on a call, and then we looked up what SOFR was in this current moment just to kind of gauge where we would be. And we're both pleasantly surprised that it was lower than we thought. So you're right. We're getting much better rates, much better terms. People and lenders are more excited to lend. But along with the accordion and elevator, we do need a rocket ship. But when we're looking towards the future and looking towards the rest of 2026, what do you see on the horizon?
Yeah. So I'm very optimistic for the industry as a whole for the rest of this year. I mean, we see a lot of deals here at Medkey. We're talking to a lot of business owners every day. You and I and our advisory team, that's what we do. We talk to business owners day in and day out about the ESOP options, what makes sense, value, how to position, how to plan, what the financing situation looks like. Is an ESOP right for you, right? And all that. So those calls have not slowed down in our deal volume, in terms of what's in our pipeline and so on. So overall, 2026 looks very strong, and the industry as a whole, talking to people in the industry, you hear a lot of activity out there, and it just makes sense when you look at the raw number of businesses owned by Gen X, still owned by baby boomers, and even millennials, right? And what we've noticed is the millennial and Gen X generations are planners, and much more so than possibly what their parents. So they want to create a game plan, and the ESOP is so flexible. Small minority piece. Companies like us can actually do a contributory ESOP or do the pre-fund, or we can go in with 100%. A lot of strategies out there that can get the ball rolling on a solution, on a strategy now. So those are always fun discussions, right, to have, and we're having those day in and day out. So long story short, I'm bullish, on ESOPs still, and it's the same old story, the ESOP versus private equity versus strategic, for companies that can go down the strategic path, right? So, you typically have a fork, or maybe you have three options, right? But that's it. But the ESOP is usually a sure bet, if valuation expectations are in line, and the financing and all that, the likelihood of going forward with the deal, you have a company with a good team, and so on, giving them skin in the game can make tons of sense.
Absolutely. And talking about the giving them skin in the game, what we don't really touch on it much because we're more on the front end, but what about employee demand? What's the sentiment with individuals that don't work for ESOP companies or are curious or started working for their first one?
Definitely. Employees are definitely out there and starting to realize the benefit of working for a company that has equity as part of its compensation. So ESOP companies are, it's one of the biggest models out there. So Ben, you and I talked a couple of weeks back about the trend in the Central Valley here in California, that employees in the Central Valley are actually seeking out ESOP-owned companies.
Yeah.
And we're seeing that, and once employees understand it, especially if they've worked or they had a friend, family member work for an ESOP company and got basically a surprise money. You do get a statement every year, but a lot of people don't think it's real till they actually cash out and get the money, because that's when it actually turns real. They see the power of that, and it's real. This is a real thing, and we see that across our client base. Been part of the sustainability when we work with clients, projecting out the cash flows and the buyback needs. There's a lot of ESOP wealth that's generated out there, and employees want to be a part of that, because what's the alternative? And
right.
Not having that.
Right.
Well, so the more awareness out there, more education, and as we say, hey, if you build things, if you're crucial to the organization and so on, I mean, having equity, having some skin in the game just makes a lot of sense, because I'm going to work harder, I'm going to work smarter, more efficient, and contribute to the bottom line, because it's my future, it's your future, and so on, and you have that incentive.
That's incentive is huge. And then also, like you said, when you open that statement, sometimes, my first one's $2,500. It's not all that exciting, and I'm only partially vested. But once you get 5, 6, 7 years into the plan and you start to look at it and you think, oh, that's a real number now. That's a number worth sticking around for. But also, how can I make that number bigger? And I have control over it in some part, whereas when I'm putting money in my 401k and I'm investing in Apple, Coca-Cola, whatever, I don't necessarily have control over how well those companies do. So, we're talking a lot about positive trends for 2026, but are there any cautionary notes for the second half of this year?
Yeah, and this is definitely relevant today, and it always is, but valuation expectations. And there is a difference between valuation and price, right? Price is the price at which you buy and sell something. Value is a range, and it's a value range, right? So expectations on the value front, absolutely. You read Wall Street Journal, you read, hey, these companies have no profit, yet they're valued at this. Obviously, the AI data center, that whole ecosystem, insane expectations, because they're pricing in all this insane future growth, right? And discounting it to today. ESOP companies, by definition, for the most part, are going to be mature, stabilized with some healthy growth. So overall, you're talking about probably a single digit EBITDA multiple. And EBITDA is basically another word for profit, so profit times something, and for ESOPs, nearly all deals out there, and you have some people who show you, the extreme upside using warrants and now it's higher and so on. But generally speaking, a negotiated deal is going to be in that single digit. And it depends what industry you're in and what the future cash flows are and, what your overall cap rate is on the valuation, and so on, the risk, the comps. So valuation, that's always it. And, we always start off with that discussion so that we have something rooted in reality with our clients. And we have access, of course, been to all the databases and all the deals we've done and, and so on. So that's always the first discussion if you want to go down the ESOP path is understanding that value range. And so Is that interesting? What's the lever if I actually achieve, if the company has very high growth rate, what does it look like if I stay the course and maybe do a small deal now, get some liquidity off spread ownership, and then do a bigger deal in a couple of years. And we do a lot of those, the minority ESOPs where you sell less than 50% and you consider a control 100% sell or going to 100% several years in the future, right? And that's part of the whole discussion is, hey, where are you positioned today? Where do you want to be? Where are you headed? And what makes the most sense?
And you're absolutely right. And I think that focusing on the company itself and what moves the needle for that value, which now is the operations of the company. How much money are we putting down towards profit? How much of revenue trickles down all the way to profit? And what's driving that? And how are we best modeling that? Because, if you remember the original Tax Cuts and Jobs Act back in 2016, 2017, that was a sweeping change that changed the corporate tax rates that made everybody's business worth more because they're paying less tax. There's not going to be anything like that is just going to be a sweeping change. So it's really focusing on your fundamentals, really focusing on your company. And that's where the value is going to stem from is the operations of the company and future cash flows. So
exactly. ESOP, cash flow buyer, that's what it is. The cash flows of the company is what supports the debt overall. So it all has to work out, right? So it's fun stuff though. So yeah, we talk about these conversations every day, then ESOP fit analysis. Hey, how does this whole thing shake out?
No, absolutely. And I laugh because you're absolutely right. We do talk about this every day, multiple times a day. And it's a good thing. There is strong activity. And, the fact that we're seeing more creative financing and that ownership culture, that skin in the game feeling is continuing to gain traction and everybody's seeing it.
Absolutely. And I know you and I are both kind of valuation heads here. One of my pastimes is taking a look and bringing a trade to the car auction website and guessing where I think, whichever car, where it's going to trade, and then going back and looking at the results. And, because these are 7, 9, now I think the premium's like, 11 days maybe, long auctions. Okay, how close was I? I just feel so good.
Yeah. No, it is fun because you think about, what are the elements that go in and into a sale. And sometimes you get somebody, and that's what we mean by strategic. Somebody's going to come in and find something that is valuable to them and only them, and will pay more. But by and large, it's going to fall within a certain range.
Absolutely. Yeah, there's a lot to be excited about here. A lot of good stuff. And, let's see what happens with the that ESOP lending bill. We're definitely tracking that closely here. We're going to keep everyone updated as we learn more there. As well. So yeah, everyone, that's it for today. Thanks for joining us. Hope everyone has an awesome day. Shoot us a note to talk about ESOP Fit. Follow us on LinkedIn, Spotify, YouTube, Apple, or Makey.com. Have an awesome day, everyone. Thanks for joining us. Take care.
Thanks. Goodbye.